The first half of the year for the markets, but not all IPOs are created equal. And Leslie Picker joins us now for more on what's made for a successful listing in the first half of 2019 and maybe what's made for a little bit of a lesser one.
Exactly, Andrew. That's very much the case. Not all IPOs are the same, and some in the first half of the year had characteristics that made them more loved by investors than others. For one, those with recurring revenue. Software companies like Zoom Video and CrowdStrike each have predictable yet growing revenue streams. Investors drove shares of both companies to the stratosphere in their debuts, and they've managed to trade well above their IPO prices since then. Another characteristic, growth into profit. Now, that's not to be confused with growth at all costs, like Uber and Lyft tend to have those characteristics, at least according to investors. But growth into profit means that investors see a pathway to profitability by toning down things like ad spending or back office costs a bit. Examples with this characteristic include Chewy growing at 68% with relatively modest losses, and Pinterest, which has top line growth of 60% in a similar loss profile. And lastly, emerging markets versions of successful U.S. businesses. China debuted its own revamped version of Starbucks called Luckin Coffee, and Jumia is largely seen as the Amazon of Africa. Investors who missed out on the Starbuckses and Amazons here in the U.S. were hoping for a second chance with these international IPOs that were listed here in the U.S.